Of course, we have the COVID front and center, and you say that the impact likely broadly neutral. But taking a more medium-term perspective, are you expecting any impact, perhaps, more medium-term in terms of landlord insurance cover? What are you looking at?
Look, it's very hard to tell. I mean, the outlook is very uncertain. This is a health crisis. It's primarily a health crisis that's flowing through economically. So the foundations of our business remain very strong. What we've done over the past 12 months is build a very strong balance sheet, make sure that we've got the right amount of capital, funding and liquidity so that we can contemplate any set of scenarios. We've got great provisioning in terms of our banking business. As you said, we built our natural hazard allowance up. We've got good reinsurance. And so we see now COVID as a real opportunity for us to transform our business, get more digital sales through and be very robust into the future.
I'm just wondering how much clarity you have for Suncorp, because estimates from 10 analysts suggest annual earnings growth of just about 2.4% in the next 1 to 3 years versus an industry growth of 16%. What's your take on that?
I think we've got a great opportunity. We've built the foundations of our business now. We know that our customers are increasingly want to interact with us digitally, and that provides a great opportunity for us. We've got the good foundations of digital capability in our business on both the insurance and the banking side. We need to continue to leverage that. We've got all the core skills in our organisation, and the more that we can service customers digitally, the more we grow our revenues, but most importantly, we bring down the cost to serve, and that will make our business more efficient and will drive more earnings capability through the group.
Steve, it's Yvonne in Hong Kong. What does this mean for claims? Do you think that claims will remain on a rise given the fact that you've seen landlord insurance? I'm wondering how that's going on now that you've seen people have to cover for rents as well. Or do you think the claims picture is still quite manageable given the fact that it's been offset by fewer motor claims?
I think that's the case. I think, we saw a net neutral outcome from COVID-type activities on the claims side over the course of FY20. I expect that to be the same in FY21. Yes, there's some uncertainty around business interruption type claims and landlord claims. My thesis is, and I expect fully, that landlords will, when the tenants will work out amicable agreements around rental going forward, that we won't see a mass eviction process once the government moratoriums come off. But again, frequency will go up and down depending upon the level of restrictions that are in the economy. And I would consider that broadly that for FY21, a similar sort of outcome to FY20, which is a net neutral outcome for claims.
And for premiums, we've seen some prices have increased in some of your products as well, but there's been also that offset of a temporary decline in new business as well. Do you think premiums are going to stay flat? What sort of trajectory are you seeing for the rest of 2020 and 2021 now?
Yeah, I think the trajectory on premiums is very much dictated in Australia by the significant increase in frequency and severity of natural hazards, and you would have seen that through the prism of the bushfires last summer. Now, what that's done is drive materially up the cost of reinsurance and the allowances that we hold within our business for those types of events. So when those increases go through so significantly across all the reinsurers and they hit the primary insurers, we have to reflect that in premiums. So certainly on the homeowners side of our insurance business, I expect premiums to rise there given the increased costs of reinsurance from weather. And on motor, it'll be a bit of a mixed bag because in motor you're seeing frequency fall away, severity probably pick up a bit in a lower accident type environment. So, and the cost of parts increasing. Cars are becoming more technologically capable, but equally they're becoming more costly to repair. Bumper bars have more technology in them today than they did 5 years ago. So there'll be a mix of input factors, but generally I think we'll continue to see premiums track up alongside the underlying inflation in both those portfolios.
Steve, there's been so much speculation that Suncorp is selling its banking operations. You've pushed back on that idea, but why maintain the banking operations when the outlook is not looking too great with rates, at record lows, with the possibility of rising bad loans?
Yeah, you're right. Every 6 months there's another round of speculation about our bank. We have a very strong bank. It's a good regional bank. It earns a A+ rating as being part of our group. So it has huge capital benefit. You can see through this result that it's a low-risk bank. We've got plenty of opportunity. And our focus is on capitalising on that opportunity and growing the bank organically. I don't see any pathway in the short to medium term for us to be distracted by any inorganic activity. Our challenge is to get returns on that banking business above its cost of capital. And we think there's a great opportunity for us to do that over the next 2 or 3 years.
You, of course, have a new banking CEO. What will be the priorities? What changes, what shifts can we expect?
Well, I think it's getting the business done as per the discussion we had 12 months ago, which is, we need to do better in our lending, our home lending particularly. We need to do a better job of servicing brokers. We have to reduce our turnaround times in terms of our lending activity. We've got to win in Queensland. This is our home market here in Queensland. We've got sort of around 8% share when the major banks have got between 15 and 20. There's no reason why we shouldn't be doing better. Continuing to leverage our digital capability. We've got good digital assets for the bank. We need to capitalise on that. Open banking, the new regulatory environment for banking, is a great opportunity for regional banks and for Suncorp particularly. So there's a big laundry list of activity that the new bank CEO has to undertake. Very capable executive from the Commonwealth Bank. We were able to get him from the Commonwealth Bank, and I'm very confident that he's got the right program of work ahead of him to really grow that organic capability within our banking business.
Steve, I just want to pick up on your return on equity. Right now, it stands at about, 8.2% versus 11% for the industry. What are you doing to boost the company's ROE?
Yeah, absolutely. That's the absolute area to focus on because, what we're driving to in this business, and it might take us a couple of years to get there, is to deliver returns on equity ahead of our cost of capital. Because that's creating shareholder value when you're doing that, and by definition you're not generating shareholder value when your return on equity is below your cost of equity. So we've got a big program of work. We've got to continue to transform our business. We've got to continue to focus on making our business more efficient and servicing more of our customers through digital. That's the pathway right across banking and insurance and in New Zealand that gets our returns on capital above our cost of capital, which is around 9.5% to 10%. So we've got a fair way to go, but a very well laid out program of work over the next 2 years to get us there.
And Steve, you've also lifted your 2021 natural hazard allowance to 950 million Aussie dollars. We've seen the natural disasters last year where you've seen a notable pickup in claims on that front. At the time, you called for this nationwide call for climate change, for disaster resilience. How much progress has been made so far?
Look, not enough. I think my arguments today, sort of build on arguments I made 6 months ago. We have a great opportunity in this country, particularly through the prism of economic recovery, to have a fiscal stimulus program that is nation building. But it's lined up very much around building the resilience of our communities. We shouldn't be, as an insurance company and as a government, coming around after these events and cleaning up all the time. A dollar invested at the front of the process in improving the resilience of housing infrastructure, community infrastructure, whether it be dams, whether it be levee banks, whether it be incentives for people to put better quality roofs on their houses, whether it be removing taxes and charges from insurance policies and products. All of these initiatives need to be on the table because they are both nation building, improving resilience, but they're also stimulatory. They will create jobs and economic output.
And in your climate update that was released today, it was interesting to note that Suncorp, you guys are going to stop underwriting, financing, or directly investing in oil and gas projects and phasing out that underwriting by 2025. Do you view that gas perhaps is not a transition fuel, or that we're already well into the transition into a low carbon world? Yeah, look,
we obviously are supportive of the Paris agreements, and again, we're making a very principled and very forthright stand on disaster resilience and mitigation. So I think, to have full credibility in that process, we need to make sure that we've got all of our processes in place and all of our activities that we undertake as a business in the right order. We spend a lot of time on our underwriting, we spend a lot of time on our investment policies and having responsible investment programs. The other point I would make is that oil and gas are not big parts of our underwriting program. Less than 0.1% of our underwriting is in those sectors. So it's probably a pragmatic decision on our part to say we don't underwrite in those areas, and going forward we're not going to be doing that. It's not within our risk appetite to embark upon that sort of level of underwriting anyway.